underwriters are probably underwriting from a place of fear. It permeates every company right now. How fearful? Well, it depends on the disposition of where you work. The thing is, fearful underwriting equates to longer findings, more ticky-tack conditions, and my personal favorite, conditions that beget more conditions, and of course, stickier interpretations regarding income, and LOEs that border on court hearings. And as I said a moment ago, it's probably going to get worse before it gets better, but don't shoot the messenger over here. But the question we need to be asking ourselves is, why is this all happening? Because like appraisals, where we had to demonize appraisers for the pending policy changes that we're about to see, or back in the 2008-9 area when we had to demonize mortgage brokers as the cause of every problem with mortgages, again, we have to demonize underwriters now, and our borrowers, and the disposition, our status quo in the industry, to rationalize where we're at and what needs to be done and changed. Case in point, according to a recent op piece by Dave Stevens, independent mortgage bankers feel like the government-sponsored enterprises are not being consistent with comments made in recent years about materiality and options for remediation, and they fear retribution if they make these points. So instead, independent mortgage banks simply engage with the respective GSEs each month to try to get them to take back the repurchase requirements on this loan or on that loan. It's a loan-by-loan drudgery that takes staff, time, and adds cost to a lender's bottom line. And this is at a time when the customers of Fannie Mae and Freddie Mac are losing money. That would be your company, or barely breaking even. The GSEs are having a heyday. And as was reported last week in Insider Mortgage Financing, for example, Freddie Mac racked up $2.94 billion in net income in the second quarter, up 41% from the first quarter and 20% from the same period last year. This marks the enterprise's fourth consecutive quarter of increasing profits, which reached their highest level since the first quarter of 2022. Okay, this all culminates in fearful underwriting, and that means more complications for the loan officers, realtors, and the borrowers that they represent. It creates more work where it not only doesn't need to happen, and we just saw that from Freddie's profits, but it shouldn't be happening. Further, this is a trend that's not just coming from the GSEs. Rather, it's a national or government groundswell. Case in point, a working paper from the Philly Federal Reserve titled Owner-Occupancy Fraud and Mortgage Performance. Now that states that fraud caused the last bubble, and if unchecked, it's gonna cause the next housing bubble. Either way, they suggest a housing bubble, and this little white paper is a preemptive game of blame and finger pointing, and it's pointed right at you, the mortgage loan officer in the independent mortgage bank. Quote from the Philly Fed working paper: "It was pervasive during the bubble and did not just affect private securitized loans appearing in both government-sponsored enterprises, guaranteed, and portfolio-held loans. More significantly, we also show that fraud continues to remain a concern appearing even in recent originations." Yes, that's right, my friends. In short, the boogeyman is still lurking. It's you and it's your clients and your fraudulent loans that are going to cause this bubble to pop. It's not the policy of the government. That couldn't be the case. You see, the policy of the government is sound. It's fine, bordering on being great, and loans would perform perfectly if only you and your fraud hadn't shown up to the game. And this, of course, culminates in fearful underwriting trickling down to you and your clients. Right from the Fed, right? And now we know the effects are real and tangible. And we can qualify this from the Mortgage Bankers Association's Credit Availability Index. Here's the graph. Do you notice anything? Yeah. Credit availability has fallen off a stinking cliff at exactly the wrong time. Manufactured fear, my friends. Now we know from the Fed that this market is your fault, and we know they're coming after you for your part in this fraud. Did you know that the Fed has interagency cooperation with the Internal Revenue Service, and they know those homes that are occupied are not owner-occupied, and where fraud was likely the outcome of your originations? That's what this paper from the Fed is all about. Once again, from Dave Stevens' opinion piece, Jaron Seedberg of TD Cowen released a report that states, "Our worry is that Washington policy changes can contribute to a mortgage credit crunch in the coming years as banks face capital challenges and a tougher economic environment, while the government appears unlikely to take key steps to ensure non-banks will remain key providers of mortgage credit." Again, the government thinks there's more fraud. They need there to be more fraud because we can't have a bubble be the result of government policy. So, let's go find some fraud. Let's go look at your originations on an owner-occupied, a non-owner-occupied, investor level, and see how that plays out and work with the IRS. And what happened? Well, would you look at this? We found more fraud. And how did that work out? Well, they found more fraud. They found more than they thought, even on loans that are performing, kind of setting the stage for things to come. Don't you think? So, as a loan officer, just understand these points. If you have multiple mortgages on your credit report or a recent history of mortgages, you've probably already been audited by the IRS and the Fed, but also understand your underwriters are going to look at these files in a way that they hadn't just a few short years ago. What you need is to have an underwriter who's not underwriting from a place of fear, but that is easier, my friends, said than done. Hope this helps. Hey, loan officers, right now it's a pressure cooker environment in our industry. Chances are it might even get a little bit stronger. But over here, what we're doing is we're crowdsourcing solutions to problems from loan officers' perspectives. So if you want to be a part of our team to fix some of these problems, just reach out to us. Be a part of the solution. Be a part of our team.